Many investors find it difficult to know what to invest in. It's even more difficult to know how to create the ultimate investment portfolio. In truth, it depends on your situation, your investment goals, your short-term needs, and your risk tolerance. In general, we claim that it mostly depends on your age. If you're young with little money invested, you should be able to handle a high risk. If you're retired and your entire life savings are on the line, you probably have a much lower risk tolerance. In this video, we will guide you towards the ultimate investment portfolio at any age. There are many other videos on this same topic, but we have a different approach, and we'll cover some advanced options, so stick around to the end. This is investing in a nutshell. Many of us start with investments in our 20s. If you're among the few that started before your 20s, then that's great for you. When you start investing, you typically don't know anything. You might know some theory. Maybe you've read a book or two. Theory is an important baseline to find success as an investor. But in order to become a good investor, you also need experience. If you've never seen a recession, a boom, a bust, corrections, bull markets or bear markets, then you don't know how you'll handle them. How will you deal with a terrible loss? Or with fantastic gains in a short time? It's one thing to read books or watch YouTube videos, but the only true way to learn is by investing. In your 20s, your ultimate goal should be to learn as much as possible. Make every mistake you can possibly make. Most personal finance channels will not tell you this, but you should make mistakes. That's the only way to truly learn. If you make mistakes in your 20s with low amounts invested, you will recover. If you make the mistakes in your 40s or 50s, you might never get back to the same levels. You might lose everything. We recommend using your 20s to try various investments, with obvious choices such as index funds and stock pickings. You should examine dividend investing, cryptocurrency, and real estate. At this time in life, you can afford to take huge risks. Just be careful with leverage and shorting. The one mistake you can never do is to invest money that you can't afford to lose. As long as you don't borrow money that you use to invest, you'll be fine. In order to answer the question of this video, we think the ultimate investment portfolio in your 20s should be 50% index funds, 40% stock pickings, for instance, based on dividend investing, and the remaining 10% with high-risk investments such as cryptocurrency. The key takeaways from your 20s is to build a habit of investing, living a frugal life, and most importantly, learn as much as possible. Get started, make mistakes now while you can, and then you can use all the knowledge in your 30s and beyond. In your 30s, it's time to harvest all the knowledge you have gained. If you invested consistently and did some decent investments in your 20s, you should have a decent-sized investment portfolio by now. It's time to dial down the risk level from super high to normal high and make wise investment choices that will make your portfolio prosper. In your 30s, you can still afford to take some risk, which leaves you with many options. As always, stocks are an obvious choice with both index funds and stock pickings. You should be able to evaluate a company based on its financial statements and determine which companies you think will prosper over the next decade. If you don't know how to do this, you should take it as a good sign, because then you know you should stick to index funds. 90% of investors can't beat the index, meaning you will beat 90% of investors if you simply invest in one or several broad index funds. We can't forget real estate. Real estate investing requires knowledge, persistence, and work, but can be extremely effective. Good investors can scale a real estate portfolio fast, and is therefore a good supplement or replacement for stocks. Both stock pickings and real estate require knowledge and work, while index investing is easy and requires low effort. Therefore, we believe that the ultimate portfolio in your 30s would be 60% index funds, 35% stocks or real estate, and 5% crypto or high-risk investments. We know you still gotta play around and have some fun in your 30s as well. When you reach your 40s, you're going to have a midlife crisis, either buying a Tesla, a motorcycle, or a boat. When you do, make sure to not extract money from your investment portfolio, as it still needs time to grow. All jokes aside, by now you should have realized that you are like most investors. You're not able to beat the market over time. The best investments for you are index funds. We must give you a round of applause if you are one of the few who can beat the market either with stock picking or real estate investments over time. If you are one of the few, then you can continue with the great work. You don't need our advice for now, but you might get some good inspiration from the retirement portfolio we introduce in the end of this video. In your 40s, you should also start converting some of your portfolio into bonds. Bonds have much lower risk and volatility than stocks, and will therefore be a great mechanism to reduce the risk. Furthermore, bonds usually have an inverse relation to stocks, meaning they will rise when stocks fall. Note, however, that this is not always the case, as we say in 2022. It is therefore possible to have better results by having a combination of index funds and bonds in your portfolio. Using rebalancing, you can take advantage of both high prices for selling and low prices for buying. We recommend rebalancing your portfolio twice a year. In your 40s, we recommend that 90% of your investment portfolio should be in index funds, and that the remaining 10% should be in bonds. Rebalance the two twice a year to the same base ratio. In your 50s, you're closer than ever to retirement. You've seen both bull and bear markets several times by now, and know why you need both to reduce the risk and volatility of your portfolio. In addition, you have seen the power of rebalancing a portfolio consisting of index funds and bonds. Therefore, you don't make that many adjustments. You simply increase the percentage that bonds represent in your portfolio. Our suggestion is to still have 80% of the portfolio in a mix of index funds, and the remaining 20% in bonds, rebalancing the portfolio twice a year. The last decade most of us are working is in our 60s. The final decade where you receive income from working before you start draining from your investments. It's time to reduce the risk further, using the same strategies in your 40s and 50s, but adjusting the composition. In your 60s, you should have 60 to 70% in index funds and 30 to 40% in bonds, still using rebalancing to take advantage of price fluctuations twice a year. This leads us to the final stage, retirement. Most of us will retire at an old age, but this will also be a scenario for those of you that achieve wealth early and want to retire at a young age. For your retirement, we'll introduce two alternatives, a basic strategy and an advanced income-based strategy. We highly recommend watching to the end. The basic strategy is, as you could imagine, to follow the strategy from your 60s, with adjustments to the bond ratio. Invest 50% of your portfolio in index funds, and make sure to reduce the risk by spreading it out. You should include both big U.S. companies that you find in the S&P 500 index, as well as smaller U.S. companies. You can find those in the Russell 2000 index. In addition, you should also include an index for Europe and one index for emerging markets. The remaining 50% of the portfolio is for bonds, preferably using a combination of U.S. Treasury bonds and corporate bonds. Twice a year, you should rebalance all these indexes back to its base ratio. Specifically, we suggest investing 25% in an index following the S&P 500, 10% in Russell 2000, 10% in an index following European companies, and 5% for emerging markets. On the bond side, we suggest 25% in U.S. Treasuries, 10% in other government bonds, and 15% in corporate bonds. This brings us to the advanced investment alternative. Before we deep dive into the strategy, we must give credit to its creator, Jason Kelly. Once you're retired, you usually need to subtract money from your investment account in order to cover your life expenses. Using the simple strategy we just discussed, you typically need to sell parts of your assets in order to extract the money. But there are other asset classes that we've not covered that pay out dividends every month. The advanced portfolio will consist of 3 different assets. The first one is simple, and it's bonds. In most retirement portfolios, you do need bonds to reduce both the risk and the volatility. The second asset might surprise you. It's an ETF called TQQQ, which is a 3-time leveraged index tracking the NASDAQ 100. What on earth is a leveraged fund doing in a retirement portfolio? We must emphasize that TQQQ is a highly volatile fund. When stocks fall, TQQQ will fall hard. And when stocks rise, TQQQ will outshine almost anything. Since the TQQQ is based on the NASDAQ 100, We know that the underlying assets are great tech companies like Apple, Alphabet, Microsoft, Amazon, and Tesla. These companies have a proven track record of printing an absurd amount of money in most market conditions. They will have downturns, like in 2022, but they will most definitely also have upturns. The power of this portfolio is the combination of bonds and TQQQ, which will let you harvest the profits in a bull market, as well as utilize the opportunity of cheap prices in a bear market. How? With quarterly rebalancing of the portfolio. Just as with the simple strategy, we need to use rebalancing to optimize our portfolio in any market condition. The final asset of this portfolio is an ETF called QYLD. It's a fund that uses covered calls against the NASDAQ 100. We can't dive into what this means technically in this video, as it will become too long. But if you want us to cover how QYLD works, just comment QYLD in the comments section. In a nutshell, QYLD will pay dividends every month, and historically it has a dividend yield between 10 and 15%. The magic is that the dividends are paid monthly. You can expect approximately 1% of the invested value as dividends every month. The goal for QYLD is that the stock price should be stable over time, but during severe bear markets, the stock price will decline. The entire portfolio with all the three assets will rebalance once every quarter. Given all this, what is the optimal portfolio composition using this strategy? The base portfolio allocation from Jason Kelly dictates 40% in QYLD, 30% in TQQQ, and 30% in bonds. At the end of each quarter, you should rebalance these to harvest any profits from TQQQ in a bull market, and to take advantage of cheap prices in a bear market. You're also able to extract the dividends from QYLD to cover your living expenses, enabling you to withdraw money every month. In conclusion, you need to use your 20s to learn and make mistakes, because you can't afford to do it later. In your 30s, you should have learned from your mistakes and realized that index funds are a wiser choice. But most of you will want to play around with a certain percentage of your portfolio. In your 40s, 50s, and 60s, you know the truth. You can't beat the market. You should invest in index funds and bonds and rebalance twice a year. Once you reach retirement, we have provided a simple strategy and an advanced strategy. The advanced strategy will pay out a monthly dividend from now and hopefully to the end of your time, leaving your investments intact to grow over time. Remember to always do your own research before you do any investments. We've described how we think a portfolio should be composed, but this is not financial advice. Seek professional advice if you need to. We hope you've enjoyed this video, and if you have any question or comment, we love your feedback. We read all your comments. If you like this video, we would appreciate a thumbs up, and you should consider subscribing to the channel so you don't miss any new content. Have a great day and good luck on your own investment journey.